All right, it looks like we are at time, so let's go ahead and get started. My name is Chin Chun, and I'm with NACBA in the Consultants Training Institute. Before we get started, I want to go over a few housekeeping items. First, to obtain CPE credit, if you have an ABW International subscription, please answer all the poll questions that pop up on your screen during today's webcast. If you have any questions during the webinar today, please use the Q&A option for any questions you may have for the presenter. We will moderate that and ask the questions to Professor Schwetzler on your behalf. If you have any technical questions or questions about NACBA, please feel free to use the chat feature as those will be directed to me. Let's see. At this time, we have the disclaimer here and some additional information about the CPE that's available on the materials. And also, here are a list of our technical editors. We have Wolfgang Nies, who is joining us today, Andrew Newman, Pratik Shah, and Brian Jones as our advisor. And with that, I'm going to turn the time over to Wolfgang, who will get us started with our presenter.
Yeah, thank you, Chanda. Welcome also from my side. Welcome from Germany. Yeah, it's a pleasure for me to introduce Professor Bernhard Schwetzler. He is chair of financial management, shareholder in Leipzig as a graduate school of management in Leipzig. He's one of our founding members and board member of EACVA. He is a renowned author and speaker for a wide range of topics in business valuation and also private equity. This is his second field besides business valuation. He's done research, a lot of empirical research, and also this empirical research is the fundament for today's Around the Valuation World shows. Yeah, let's have a look. Let's take care on the private equity industry. And the topic today is buying performance, the impact of buy and build strategy, the impact of multiple arbitrage and buy and build strategies. Yeah. Having said this, I hand over the micro to Bernhard.
Okay, thank you, Wolfgang, for the nice introduction. I try to share my screen for my presentation. Does it work?
Yeah, perfect.
Okay. So yeah, as Wolfgang mentioned, the topic of this talk is not directly and closely related to corporate valuation, but still very interesting. It is located, as Wolfgang already mentioned, in the private equity industry, and it deals with, I think, currently the major value creation strategy in private equity, that is buy and build. And it raises two important questions. The first one is the performance of buy and build strategies higher or better than the one of standard buyout strategies? And if so, and that's the second question, what are the sources for the outperformance of buy and build? And we will find that this multiple arbitrage that I will explain in a second is one of the major reasons for the outperformance of these buy and build strategies in private equity. Yeah? So yeah, this is the content. We will start slow and we will dive a bit into the private equity industry and stress the importance of buy and build as a value creation strategy there. And then I would like to show and introduce a nice way to measure performance in the private equity industry. That's usually done by IRR. But the nicer part of this is there is a way, or has been developed a way, to split the performance into several components. And that's something that I would like to show because we will use that performance allocation measure in order to split the performance of regular buyout deals and compare it against the split of the performance of buy and build deals and compare it against each other. Yeah? And then we will find out that we will have to adjust that split a bit for that multiple arbitrage. And finally, I'd like to share some empirical findings that we have been publishing recently in a paper based on a sample of buy and build transactions, which is, by the way, the first one, at least to the best of my knowledge, that shows the contribution of performance and of outperformance of this multiple arbitrage part in buy and build deals. Okay, so let's step into this. This is a slide that we have borrowed from a joint study from the Boston Consulting Group, and that simply highlights the importance of buy and build and M&A as a value creation lever in private equity. What is buy and build? I think that's probably generally known, but I repeat it. That is a private equity fund buys a so-called platform company and then makes so-called add-on acquisitions and merges these add-on acquisitions with a platform company. Yeah? So there are quite plain buy and build strategies or so-called roll-up strategies. That's something that we observe currently in Europe, sometimes in the medical area. For instance, dentists practice in the Netherlands, and I think in Italy as well, are rolled up. That means that, I mean, there is no typical platform company. So you start simply with one dental practice and then add the others on top of that. But there are also more sophisticated buy and build strategies where you need a particular platform company with particular features, particular size, or maybe particular technology properties, and then you add some other add-ons to that. And that, as I said, is meanwhile has become standards. It started out in the early 2010s, but meanwhile it is some sort of a standard toolkit of value creation, and many private equity funds and private equity companies try to use that in order to improve the performance of their portfolio companies. And that is the famous Bain Global Private Equity Report, which is, a bit of a Bible, at least in the private equity industry. And you see that the report in 2018 was directly focused on this buy and build strategy. And this headline here, private equity firms are increasingly beating corporate buyers at their own game, relates to the fact that in the good old times, when private equity sometimes competed against strategists in transactions, the saying was always that private equity is bidding for access to cheap debt, whereas the strategists are always bidding for synergies, because they have an operating business that they can combine with the target. But as this quote already suggests, there was some sort of a game changer meanwhile due to this buy and build, because now then owning the platform company, of course, private equity also has its own operating business. And by adding another company to it and merging it together, of course, now all of a sudden, private equity is able to create synergies and value via synergy creation on their own. So in that sense, that is going to change the good old competition landscape between strategic bidders and private equity as bidders. So when talking about performance and outperformance of buy and build deal, it's important in that sense to have the right metric. And despite of years of efforts of finance professors warning their students not to use IRR, IRR is still the prevalent and widespread in use performance measure in the private equity business. So if we look at the different levers for value creation in these buyouts, then of course one, that's the first one on the left-hand side, is delevering. That means usually all the cash flow that is generated in the buyout is used in order to service the debt. So there is hardly ever a dividend paid out to the private equity fund as the equity owner. Usually all the cash flow that is generated, the free cash flow, is used in order to pay down debt. Sometimes there may be a recap where a new debt is loaded into the company in order to finance a dividend, but that's a rare occasion. So that's one layer and level for value creation. And the others, more important ones, meanwhile, are dealing with improvements in the operating business. And by doing so, of course, with increasing the enterprise value. So The left hand again is optimization of the operations and the free cash flow. That is sales expansion, margin improvement, increasing the profitability, and finally improvements in working capital management. Yeah, so this is then in that sense increasing the free cash flows that the performance company is going to, the portfolio company is able to deliver. And we will dive a bit deeper into what is labeled here multiple arbitrage, or to be more precise, multiple conversion. What is meant by this? This is simply meaning that you are able to sell the portfolio company at the exit, because private equity usually has holding periods only of 3 to 5 years on average for its portfolio companies. So you are able to get a higher multiple when selling the company at the exit than you have paid for the company at entry. Yeah, so that is regularly called multiple conversion. We loosely have already called it here multiple arbitrage. We'll see that there are some slight differences between these two labels. Yeah, where does this come from? Well, maybe it comes from simply riding tailwinds from the market, so that the market has been going up then, and you have a better exit then, or the other way is you have a better negotiation power than when negotiating with a deal at the exit channel. Or maybe actually the company well deserves a higher multiple because you have, in that sense, created additional potential for value creation, for instance, by buy and build. Yeah, so that is why we'll dive a bit deeper into this reason, or into this level for multiple creation. Yeah. So, and this is a scheme that has been developed, I think, 15 years ago, I think by Oliver Gottschalk from HSC, how to split the performance measured by the IRR into different components. Yeah. So the idea is that you have a certain value or valuation equation at the entry. That is when you buy the portfolio company, and of course you have the same chain of value calculation at exit when you sell it. So you see here we start with a certain sales figure at the beginning. If you multiply the sales figure with a particular EBITDA margin at entry, then you have the EBITDA itself. If you multiply the EBITDA with the entry multiplier, then you got the enterprise value. And if you multiply the enterprise value with the leverage factor at entry, then you get your invested equity. That is what you spend in order to buy the equity of the company. Yeah. So, and of course, the same applies at exit. So you have the sales at exit times the margin is the EBITDA at exit times the multiple, enterprise value to EBITDA multiple, yields the enterprise value at exit, and the leverage factor at exit yields the value of the equity at exit. Yeah, and the important assumption now in this calculation is now that regularly private equity investments are spot in and spot out investments. That means there are no intermediate cash flows that go into the pockets of the equity investor. That means all the value that is created comes from the exit and comes along as capital gains. Yeah, so there are no intermediate cash flows, and that allows now to link the different figures at exit with the corresponding figures at entry and connect them via growth rates. Yeah, so you may say that the sales figure at exit is the sales figure at entry times 1 plus the growth rate to the power of t. T is the holding period, the number of years. Yeah. The same holds, of course, for the margin. That means the EBITDA margin at exit is the EBITDA margin at entry times 1 plus the annualized improvement as a growth rate of the margin to the power of t. Then the same holds for the multiple. That means that you may annualize the change of the multiple between exit and entry as a growth rate. And finally, usually as you use the entire cash flow, free cash flow, in order to pay down debt, of course, the leverage factor at exit is also significantly different to the one at entry. And you may also express this as an annualized rate of change. Yeah. So that is true for the left-hand side of the equation. And of course, it's also true for the right-hand side of the equation. That means that, of course, the value creation is the difference between the value of the equity at exit and the value of the equity at entry. And that allows now to calculate the annualized growth rate of the invested equity as simply as the IRR. Yeah, that's the internal rate of return that is, in that sense, coming along as capital gain, and that is simply annualized the IRR of the deal. Yeah, and now you see that this equation allows, or this scheme allows, now to express the IRR as annualized growth rate of the equity as the product over the 4 annualized growth rates of sales, margin, EBITDA multiplier, and leverage factor. Yeah, and that is the famous equation that is meanwhile widespread in use. You see here on the left-hand side, this is 1 plus IRR to the power of t. That is the accumulated value creation as capital gains on your equity, annualized as the IRR. And on the right-hand side, you see the product over the 4 growth rate of GR is the growth rate, excuse me, of revenue. GRM is the annualized improvement of the margin, the EBITDA margin. GM is the annualized change of the multiplier. And G1 minus L is the annualized change of the leverage. Yeah? So as the two are equal to each other, so left-hand side of the equation is equal to the right-hand side, this allows to disentangle the realized IRR into these 4 components. Yeah, sales growth, margin improvement, multiple conversion, and deleverage component. Yeah, and that's quite important because increasingly in the private equity industry, the limited partners as the investors are not only satisfied by the IRR that they receive at the end on their investment, they also are interested in how this IRR is generated. Yeah, and the reason is that many limited partners are also professional investors and can reap at least a part of these sources on their own. Yeah, for instance, if you have a pension fund that invests, of course, the pension fund may create a market portfolio of listed companies and leverage this investment into this market portfolio, and by doing so, at least get the 2 right-hand side growth rates on his own without having to pay a general partner of a private equity company. Yeah? So let's make an example. Yeah? So you see that here we log scale both sides of the equation. And then, of course, you see the components here of the 4 levers that, of course, then have to sum up to 100%. Yeah. So you see here our example. We have an entry in the year 2008. We have sales and revenues of 100 million. 50% margin is 15 million EBITDA. 6.5 is the entry multiplier. That translates into 97.5. I have to look this up. 97.5 as an enterprise value at entry times 45% equity. That is an invested equity of 43.87 million. Yeah. At exit, we have 130 million exits in 6 years. That's an annualized growth rate of the sales and revenues of 4.5% per year. Yeah. We have a margin improvement from 15% to 18%. That is annualized over the 6 years, 3.1% growth in the margin in margin improvement per year. So we have 130 million times 18% margin. We have, this is 23.4 million EBITDA times a 7.1 multiplier at exit. That translates into 166.14 million enterprise value. And as we have used all the free cash flow generated in the 6 years in order to pay down debt and service debt, now we have an equity fraction in the enterprise value of 65% from 45%. Yeah, and that translates here into roughly 108 million of equity value at exit. Yeah, So we already have talked about the growth rate of these two value components here and value drivers, revenues and margin. You see here that the multiple conversion annualized from 6.5 to 7.1 is 1.5% per year. And you see here the deleveraging component from 45 to 65 annualizes to 6.3% per year. Yeah? And here you see the increase in equity value from 43.8 or 43.9 to 107.9 is an annualized growth rate of 16.2%. Yeah, and that's nothing else but the IRR. Yeah, so that's the IRR of this deal. Yeah, the annualized growth rate of the invested equity. And now we can use this decomposing equation here and allocate the contributions of these components here to the overall performance. And you see that roughly 30% of the value creation stems from sales growth, another 20% from margin improvement. You see that the operating part of the performance contribution is about 50%. And the other 50% come from roughly 10% from multiple conversion, and 40% from delevering. That means paying down the debt that you have loaded into the portfolio company via the acquisition vehicle at the beginning. Yeah, and this composition is not only important when applied on the realized performance of the deal. It is meanwhile also important for at the fundraising, because many LPs meanwhile want to know how the projected IRR shall be earned. Yeah, and of course, as I said, the first two columns of this table are the more important one. That means the 50% contribution of the operating business to the overall performance is something that usually the LPs cannot make at home themselves. Yeah, whereas it is always a bit challenging on whether multiple conversion and deleverage cannot be also homemade by the LPs. So if you value or if you weigh these contributions, of course, investors are more happy or are happier in that sense, the higher the contribution of the operating sector to the overall performance is. And private equity itself prides itself always that this is the lion's share of the performance contribution that they see. Yeah. So here is yet another study that we did some time ago with BCG jointly, and it shows that the operating sphere, or the other way around, it shows here that of course the contribution of the leverage is decreasing over time. Yeah, the reason is, I mean, the financing side of the transaction usually has turned into a commodity. That means that there are not too strong differences between the different private equity funds with respect to their access to so-called cheap debt. Yeah. You see also that the fraction and the contribution of the multiple conversion has increased over time, but the most important one, and that's, as I said, is the standard story of private equity itself, that they say, well, we really create value in the operating sphere of the companies, and that is also reflected here by the steep increase from 18% value contribution in the early 80s to more than 40% now in the early 2000s or in the later 2000s. Yeah. So you see that operational improvements and multiple conversions have been increasing in their contribution over time. Yeah. So, and now let's look at how these figures are going to change in buy and build deals. Yeah, that means in portfolio companies that have been acquired as a platform, and then the platform company and the private equity fund have performed significant so-called add-on transactions that have been added on the platform. Yeah. So there is empirical evidence. Meanwhile, this is a study that we again did jointly with BCG on this topic. There are others as well, but of course, I prefer to show my own. The first that has been published, I think, in 2016, And you see here the first finding of our study was that indeed, and we're not alone with this result, that indeed buy and build is outperforming regular so-called standalone buyouts by 8.6 percentage point. Yeah, that's the difference between 31.6 and 23.1 percent as IRR. Yeah. So yes, the first question is answered by yes. There is outperformance, and buy and build is going to outperformance regular buyouts. Yeah. And the second thing that we did jointly with BCG was that we, of course, again decomposed the performance into these 4 layers: top line growth, that is sales growth, margin improvements, multiple conversion, and leverage. And you see that there are striking differences how these IRRs are to be decomposed. The first striking difference is you see here that even in absolute terms, the contribution of margin expansion is lower in buy and build deals than it is in standalone transaction. And percentage-wise, this is an even sharper decline in this figure. And the reason of this is, if you talk to private equity managers, is that they say, well, we are so busy in buying other companies and integrating them into the platform company and into the merged company that we don't have yet the time in that sense to streamline the operating business and to care for real margin improvements. Yeah. So top line growth is in line, but the second striking difference is this one here. Yeah? You see that multiple conversion plays a way more important role in buy and build deals as a contributor to overall performance than it does in the standalone case. So you see that it almost adds 50% or contributes 50% of the IRR in the buy and build deal, whereas it just contributes 1/3 roughly into the standalone deals. Yeah, and the reason for that is, at least that's what we found out by asking private equity managers, is that they say, well, in that sense, we have now created something new. Yeah, and we have created a larger entity. That's the first important reason for charging a higher multiple at exit. And the second one is that as we did not yet get to, in that sense, streamline the margins and go for real operational improvements, we leave this to the second buyer that is going to buy this accumulated conglomerate of companies. And so we leave some value creation potential via margin expansion on the table for the next owner. And we charge a higher price for that. Yeah? So these are the 2 major explanations for this significantly higher importance of the multiple conversion part and contribution to the overall performance. Yeah. So let's talk what that actually means when looking closer to this multiple conversion. And now let's look at the distinction between multiple conversion on the one side and multiple arbitrage. So I will introduce this term right now. What is meant by this? So sorry, excuse me. Yep. You see that usually the add-on transactions are cheaper with respect to their multiplier compared to the platform company. Yeah? So you see that we start out here with a 7.5 multiplier for the platform company, and at an EBITDA of 20, the enterprise value of the platform is 150 million. Yeah. So now we see that we have 3 particular add-ons as we go. So the first add-on has an EBITDA of 15 and goes with a multiplier of 6 because it's smaller. It is cheaper than the platform. So it goes along with an enterprise value of 90. So 15 times 6 is 90. And then we have 2 small add-ons at the end of the holding periods or later on. So both come along with an EBITDA of 5, and both are cheaper, so they only cost a EBITDA multiplier of 3. And that means that the enterprise value of these two late add-ons is 3 times 5 is 15. Yeah. And so you see that, and this is what is meant by multiple arbitrage, that as usually the add-on multipliers for the add-on transactions are lower than the ones for the platform company, this is going to reduce the overall average entry multiplier. In our case, it goes down from 7.5 down to 6. Yeah, you see that simply by summing up all enterprise values at entry and summing up the EBITDAs at entry, so 45 over 270 is a multiplier of 6. Yeah, and that means, and that is meant by multiple arbitrage, if the entire accumulated company now at exit is sold again at a 7.5 multiplier, I already have made money, so to speak, yeah, because actually I have some sort of a hidden multiple conversion, because the true multiple, entry multiple over all my acquisitions is 6. And so if I sell it at 7.5, then I already have pocketed in a significant amount of money on a significant part of the multiple conversion. Yeah? And that is called multiple arbitrage. Yeah? That is, you collect smaller add-ons with lower multipliers, and even if you sell the accumulated company at the entry multiplier of the platform company, you will still make money. And as the label arbitrage, multiple arbitrage suggests, that this is something that comes along for free, which, as we will find out, is not exactly true. Yeah, but this is the distinction between multiple arbitrage and multiple conversion. So in that sense, multiple arbitrage actually increases the multiple conversion. Yeah, so it is somehow hidden, a hidden type of multiple conversion. Yeah. So, and in our paper, we made the point that actually this is going to distort the allocation of performance in buy and build transactions. Yeah. So in that sense, you see that, as we'll see in a second, this benefit, which we call sourcing effect, this benefit, the decline of the entry multiple, is not directly seen in the regular disentangling and performance split calculation that we've seen so far. Yeah? In order to make it visible and to allocate this effect where it belongs, actually it belongs to the multiple conversion part, we have to perform some changes. Yeah, and that's what we see here in this example. Yeah, so you see that again, this is our company at entry, this is here our add-ons, and this is our exit. You see here at exit, we have a multiplier of 9. So from 7.5 to 9, this is in that sense the regular multiple conversion that contains in that sense some additional benefit. And you see here, this is our EBITDA increase that we get. So you see that here we have 15 plus 5 plus 5. So that is already 20 increase in EBITDA that we have acquired. And here you see yet another 5 is what we generate at home as the true organic EBITDA. Yeah. So, and what we perform now is yet another step for disentanglement. That is, we sort out this the effect of this add-on sourcing effect. Yeah? And we do so by asking the question, what would have been the EBITDA that we would have acquired if we would have to pay the same 7.5 multiplier for our add-ons that we have paid for our platform company. Yeah. So in that sense, you see here, the idea is that instead of the 6, 3, and 3, we say that we apply a 7.5 multiplier on these enterprise value and then look what is the EBITDA that we would have got if we would have paid the same multiple for the add-ons than for our platform company. Yeah, and you see here on the first year, 90 divided by 7.5, we would have got 12 true inorganic EBITDAs if we would have paid a 7.5 multiplier. And the same holds true for our 2 smaller add-ons. You see here that we paid 15 enterprise value for them. If we divide it by the 7.5, this is the true additional EBITDA that we have acquired when paying the same entry multiple or the same multiple for the add-ons than for the platform. Yeah. And that means that the difference between the 15 here, the 5 here, and the 5 here, and this implied 12, 2, and 2, this is what you get for free on top of it. Yeah. So 15 minus 12 is 3, 5 minus 2 is 3. So in that sense, summing up this 3 times 3, 9, this is what you get for free as an EBITDA on top of the regularly acquired EBITDA if you would have paid 7.5. Yeah. So we extract this 9 additional EBITDA that we get, as I said, in that sense for free by being able to acquire it at lower multiples than 7.5. Yeah. And we sort this out. Yeah. And now you see that the increase of EBITDA can be decomposed into 3 layers. Yeah, we start at the 20 EBITDA of the platform company, and you see here this is 12 plus 2 plus 2. The 16 is the true regularly bought or acquired additional EBITDA, 16. Yeah. And the 9 is the one that we get on top for free because it's cheaper. And the 5 is the one that we have, in that sense, established on our own by margin improvement on the combined company. Yeah. So you see here 20 plus 16 is 36, plus 9 is 45, plus 5 is 50. So we have an entire increase in the EBITDA from 20 to 50. And we decompose this right now into from 20 to 36 is the growth in EBITDA that we have regularly acquired. From 36 to 45, that's the 9 here, is the next growth that we have established due to this, as we labeled it, the sourcing effect. That is, we get some EBITDA for free. And here from 45 to 50, this is the increase in EBITDA that we see from our own operating effort for improvement. Yeah. So in that sense, we split these EBITDA growth into these 3 components. Yeah. And finally, the idea is that the growth from 36 to 45, this additional growth here due to the add-on sourcing effect actually has to be moved out from the EBITDA growth component into the section of the multiple conversion. Yeah, because that is then the sourcing effect comes along by having cheap access to additional EBTAs. Yeah. So as I said, I just would like to highlight some important findings on a recent study that we have published on that topic. This study has relied on a proprietary database from a fund of fund. And we have all in all have had 161 buy and build transactions or portfolio companies that started out and that did buy and build. You see here that there was a significant multiple conversion in our sample from 7.3 as an entry up to 9.6 at the exit. You see also that we had a significant number of add-ons here in our sample. We have to admit, it is a European sample. US samples are usually at that level not feasible because the data are hard to get and are hardly to be published, and that is why a large body of research is now performed on European deals. Yeah. So you see here, this is our buyout sample with all the add-ons that we have here. We have 103 realized buyouts that are already sold, and we have 58 unrealized ones. And here we relied on the net asset values that are provided by the funds in order to calculate the IRR based on this one. Of course, we separated the two. The results are quite similar for both parts here. And we were interested in the question, does buy and build outperform a non-buy and build? That means regular buyouts. And so we extracted also a sample of comparable peer portfolio companies and deals without buy and build. And we did so by looking at the firm financials. We had several measures that we applied in order to get peers that are as close and as similar as possible to our buyout companies. And that is then the benchmark that we compare our buy and build against. Yeah. So as I said, to the best of my knowledge, this is the first study that actually dives deeper down into all the add-on transactions. So of course, we have collected all data also for all add-ons. That means the EBITDA that has been acquired, the multiple that has been paid for all the add-ons in order to make this disentanglement that I just have shown. Yeah. So the first question that we were looking at was how big is the sourcing effect? Yeah. So is it relevant? And is this multiple arbitrage, as it is regularly labeled, is this an important thing or is it negligible? Yeah. And as I said, the second set of questions relates to the question or the overall question of outperformance. So is buy and build outperforming non-buy and build? Is the reason for this outperformance related to this sourcing effect? Is it maybe even equal to the sourcing effect? So is this the reason for outperformance if there is one? We have also, of course, looked behind the question, what are the determinants of the sourcing effect? And finally, what is actually driving the exit multiple? And how is the relationship between EBITDA growth and the components of the growth and the exit multiple that you get when selling the company at exit? Yeah. So this is a very short wrap up of the literature. As I said, there is already evidence since a while that buy and build is going to outperform regular buyouts. Yeah, so there have been several studies in the early 2000s and in the early 2010. So that's something that we know, and that will be, that's not a secret, that will be supported also by our study. Yeah. But we, I repeat myself, but I have to, we are the first one to disentangle this effect and to sort out this multiple arbitrage component and double check on whether this is the reason for the outperformance, and also look behind the scene and look what is actually contributing to this multiple arbitrage effect. Yeah. So as I said, this is unique, and that's our main contribution. Yeah. So you see here some important figures from our sample. You see that for the add-on acquisitions that we have disentangled, the first chart on the left-hand side shows that, of course, usually the add-ons are smaller than the platform. Yeah. So you see that here the enterprise value is roughly of the add-on is roughly on average 22%, and the median is even lower, is lower than 10% of the enterprise value of the platform. Yeah. On the other hand, you see here that by these spots here, we have some rare occasions where the add-ons were even larger than the platform company. You see here that that was a multiple that was even above 3.5, where the add-on was 3.5 as large or more than 3.5 as large than the platform. But that's, as I said, is an unusual case. Yeah. And the second thing is on the right-hand chart that we see here is that usually also the multiples of the add-ons are lower. So the add-ons are cheaper than the platform. Yeah. You see here, on average, the multiple for the add-ons was 92% of the multiple of the platform company. Yeah. And the median is even lower than this. Yeah. Excuse me. No, sorry. And you see that more than 70% of all the add-ons were cheaper than the platform, that is, had a ratio or had a multiple, an acquisition multiple that was lower than the multiple for the platform. But you see also that there are some rare occasions. You see here on the right-hand side on the scale, far out as an outlier. There was even a case where one add-on was 6 times as expensive as the platform company. That means that it commanded an entry multiple or an add-on multiple that was 6 times as high as the platform. Yeah, but a rare occasion. Yeah, so you see that our data are in line with what we have expected. That is, usually add-ons are smaller and they are cheaper than the platform company, and of course that points already into the direction that there might be potential for this multiple arbitrage effect. Yeah. So, and this is our disentanglement over the 145 buyouts that we have used in order to analyze this decomposition. Yeah. So you see that here the overall effect of EBITDA growth is 40 plus 8, 48 plus 10. Is 58%, is roughly the contribution to the performance of the total EBITDA growth. Yeah. And if we decompose this, then you see that only 10% is the true organic EBITDA growth that we have created on our own organically, so to speak. Yeah. And it is almost the same size, has this add-on sourcing effect. This is, in that sense, the EBITDA that we have got for free, so to speak, by paying a lower multiple for the add-ons. That's 8% contribution to the 100% IRR contribution. And you see here also 40% is the inorganic EBITDA growth. Yeah, that is simply stemming from buying EBITDA. Yeah, so you see that the lion's share of the overall value creation is stemming from bought EBITDA growth. Yeah, that you have simply bought by acquiring the add-on companies. Yeah. Excuse me. And you see here the 14.6% is the contribution of the delevering component, which is low, which is also, as we will see, significantly lower compared to the one of the regular buyouts. And the reason is that the lion's share of these acquisitions is funded by cash that is generated by the portfolio companies itself. Yeah. And that means as you use the entire cash or almost the entire cash to finance the acquisitions, of course, there's less room for using the cash for paying down or serving the debt. Yeah. And that means that this component and the weights of this delevering or equity share increase component is significantly lower in buy and build deals. And you see here, again, that's something that we have already seen in our study with BCG jointly, 27% or more than 27%, that's the regular multiple conversion. And if we add this 8.2% add-on sourcing effect, then you see that the multiple conversion is even larger than it appears to be without this adjustment. So in actually, it is 27.3 plus 8.2, and it is more than 35% of the entire value creation stems from multiple conversion. And as I said, 10% of this 35% in percentage points is the contribution roughly of this add-on sourcing effect. Yeah, so it's not negligible. It is significantly contributing to the value creation and to the IRR in the deals. Yeah. So, and that's the first comparison that we had. You see here always, depending on the peers that we have established, this is always the non-buy and build area here and the performance compared against the buy and build. And you see here that the multiple conversion, even without this adjustment, is already significantly high in buy and build. Yeah, 0.664 in absolute terms against 0.42. Yeah. And it becomes even larger if we, that's the second line here, if we add this sourcing effect where it belongs, we add it on top of the multiple conversion, then of course the difference between the two becomes even larger. Yeah. And you see here on the right-hand side, that's always a single test for equality of means between the two buy and build and non-buy and build. Yeah. And 3 asterisks always means that the difference is significant with a 1% confidence, with only a 1% error level and a 99% confidence level. Yeah. So you see also here that buy and build also has a significantly higher EBITDA growth rate. It has a significantly higher enterprise value growth rate, which we use here also as a performance measure. You see here that the net debt to EBITDA multiple change, that means that the net debt down payment is in that sense significantly lower in the buy and build deal section. And as I said, this reflects the fact that you need all the cash or the lion's share of the cash to finance the acquisitions, and you have left less money to pay down the debt. Yeah? And you see here, this is the combined performance, 41.4%, the IRR as an equity CAGR on buy and build, and you see here 32 or 31, depending on the peer group for non-buy and build, which is also different at a high confidence level. Yeah, so we can answer the first question. That's not new. We knew all that already, but again, it shows that our data are okay. Yes, buy and build outperforms non-buy and build. Yeah. So, and then we have been looking a bit deeper into that, and the upper check here, you forgive me, these are quite academic tables, but they still make sense. You see here our buy and build effect is 2.3% in the buy and build group. Our sourcing effect is 2.3% in the buy and build annualized group, and of course it's 0 as there is no sourcing effect in the non-buy and build, and the difference is also again significant at a 99% confidence level. Yeah. So, and then we ask the question, is this sourcing effect the only reason for the outperformance of buy and build? And that means that we simply remove these 8.2% out of the equation of the value creation of the buy and build deals and recalculate the IRR of the buy and build deals without that 8.2% add-on sourcing effect and compare it again against our non-buy and build. Yeah, and that is happening here. Yeah, and you see here again, this column is our buy and build, the adjusted buy and build without the sourcing effect. And you see now that the difference becomes smaller. Yeah, here, if we have this first layer here, realized and unrealized deal, the difference is not even significant anymore. Yeah, it's 33.5 against 33.4, or here 32.6. So it's no longer difference. If we have here realized buyouts and we have a size matching, that is a different way to arrive at your peer groups, then you see that in some of the cases we have still significant differences, but overall we can conclude that the lion's share of this outperformance between private equity with buy and build against private equity without buy and build is indeed stemming from this multiple arbitrage and this what we have labeled as the sourcing effect. Yeah. So, and finally, we've been looking deeper into that and asked the question, well, what is actually the reason for this sourcing effect? And I think that this is simply mixed up. Oh, okay, sorry. I'm back here, back on track again. I was a bit confused by my own slides. Sorry. So the idea is now that we ran a regression analysis. So because here, so far, we only have been looking at simple comparisons of means. And of course, now we run a regression and we have created a new variable that has on the numerator is the IRR of the buy and build. In the nominator is the IRR of the comparable non-buy and build. And this ratio is log scaled. And then we have a set of independent variables that we analyze on whether they have a significant link to the outperformance. And this ratio is, of course, an outperformance. If it is higher than 1, then log scaled, it is a higher than 0 or greater than 0. And you see here that these factors that we see here in line, they all contribute positively to this outperformance variable, but you still see that the highest contribution and the highest coefficient estimate always comes from this add-on sourcing effect as a CAGR figure. That means that still our sourcing effect that we have derived is the most important contributed to this outperformance of our buy and build. So, and as I said, then finally we have been looking deeper into it and asking the question, what is actually driving such an ability to perform such a buy and build strategy and to, in that sense, reap the benefits of these of this sourcing effect, as we labeled it. Yeah? And one thing that comes immediately to mind is that some private equity firms have meanwhile dedicated sourcing teams. That means that our teams that have nothing else to do, then always looking for potential add-ons that could be added to the platform company. So we introduced a dummy for where we knew that this private equity fund has a sourcing team and introduced it also into our equation. Yeah? The second layer that we've been looking at was deal complexity. That means that, as I said, there's a distinction between so-called plain vanilla buy and build roll-up strategies, as in the example of the dentist practices, but they're also more complex buy and build deals that cross borders, for instance, or cross industries, and of course, maybe they are the reason for the outperformance. On the one hand, they may have a positive impact, more complex buy and build deals. On the other hand, they may also have some negative side effects, that is informational disadvantages when you invest into a different country and the like. So we do not know exactly what will be the sign of this estimated coefficient. And finally, some variables that directly relate to the deals. That is, the higher the total acquired EBITDA from add-ons, the higher probably this add-on effect becomes. If the multiples of the add-ons are lower than the multiple of the platform company. Yeah, so the more EBITDA you acquire, cheaper, of course, in that sense, the more and the higher this sourcing effect becomes. Yeah, and also, I mean, the more transactions you make and the higher the frequency of your add-ons becomes, also that may also support, if they are cheaper, may also support this multiple arbitrage effect and the sourcing effect behind that. Yeah, so these were our hypotheses. And now we finally look into the tables, and you see here the first variable, our sourcing team dummy, is positive, and that means that, of course, this add-on sourcing effect is higher for those private equity funds that actually have a dedicated sourcing team in place. Yeah. So you see that we were inconclusive with the results of a cross-border dummy that obviously was insignificant, but you see also here that if this buy and build strategies crosses industry borders and combines entities out of a different industry, then obviously this add-on sourcing effect was significantly stronger. Yeah, you see here that the log-scaled annual EBITDA effect plays a slight positive role, and here you see that this is going to support our hypothesis that the add-on frequency has a positive impact on the add-on sourcing effect, because as I said, the more and the faster you acquire and the more you acquire at cheaper prices, the higher this add-on sourcing effect becomes. The holding period has a negative effect on this add-on sourcing effect, and the reason is indeed that in that sense, the holding period of these buy and build transactions is significantly longer compared to the ones of non-buy and build buyouts. And the reason is, of course, it takes some time to integrate and to acquire these add-ons. And of course, you do not want, in that sense, to sell a construction site. You at least try to integrate to a certain degree all add-ons before you actually try to sell the entire conglomerate to a potential buyer. You see also here an effect of the enterprise value on this multiple conversion, and here of the entry multiple. So you see here, the larger the enterprise value becomes, the smaller the effect becomes, because the smaller then compared to the platform company the add-ons are, or the other way around. The larger the add-ons are compared to the platform company, the stronger this effect becomes. Yeah, and here you see the log scale of the entry multiple has a positive impact. Why? The higher the entry multiple is, the higher the potential discount of the cheaper add-on multiple becomes, and the higher this add-on sourcing effect becomes. Yeah. So that was looking behind the scene and answering the question, what actually drives this value increasing add-on sourcing effect that we have derived so far. So this is my last slide. This is an advertisement for our paper. You can download the paper and you can read the study yourself. If you want to give us feedback, that's always welcome. You see that we are always eager to learn from you. And of course, if you have any suggestions and any questions that come to mind, please feel free to raise them right now. Thank you very much for your attention.
Yeah, thank you, Bernhard, for this deep dive into the value creation of private equity funds. Any questions from the audience?
Thank you.
Can't see. Thank you, Tim. One final question from my side. You mentioned that your database was focused on European transaction. Do you believe that maybe from your discussion with fund managers, these these factors are totally different in North America or Asia?
I don't think it depends. I don't think, I mean, unfortunately, the entire industry is half blind in the US because it is very hard in the US to get data on deal level from private equity funds. But I think that in developed private equity markets as the US is and the UK, in the UK
Yeah.
we see the same figures. I think that this is not different to the figures that we have seen so far. But of course, we're looking forward for someone to, in that sense, to do a study like this with data from other regions worldwide. Because as I said, we have been the first to develop this methodology. And of course, we are now looking for others to support or contradict our findings. Yeah,
yeah, thank you. No further questions? Yeah, many thanks, Bernhard.
it was a pleasure. Thank you.
Short announcement, our next rounds Valuation World show will be on March 27th with Carla Nunes from Kroll, and she will give us a new second part of the insights into the new beta calculation database from Kroll. Okay, thank you, Bernhard, again, and thanks to the audience, and see you next month.